Welcome back to the Anomaly Angle. My name is Greg.
And I'm John.
Today we're going to talk about taking an $80,000 tax bill and slashing it in half with an easy strategy that anyone can really do. So stay tuned to talk about the situation and how we untangled this mess. Before we do that, John, how was the week?
It was good. Contact switching is completely out of control as usual, right?
Tax season, man.
Yeah, we're doing sales, we're doing client delivery, we're doing, managing the team, and now we're, ripping a video on cap gains.
Yeah, well, one of the things we love doing is kind of sharing our experience at Anomaly and the real situations that we get ourselves into with clients. And this one actually came up probably about a year ago now. But what happened was a team member was talking about this the other day, and it dawned on us, hey, this is a great thing to share with the audience because it's sort of a unique situation. But you're going to see the power of proactive tax strategy as we explain the situation. And it's not going to be rocket science things here. It's really putting a puzzle together, right?
Right, yeah. And I think when we talk about capital gains, I think people probably they put that in a box as to what they think it is. And I think this particular instance really just kind of illustrates really an outside the box instance.
Absolutely. And I think the other problem here is the new client didn't even know these things were possible. So with all that, let's get into the situation here and talk about it. So probably in the late 2023, we were contacted by a prospect that basically had said, hey, they were a little scared and freaking out about this large tax bill that was coming. They thought it was around $100,000. And we said, hey, what's going on? And what they ended up telling us was that they had sold a rental property they'd owned for quite a long time out in Oregon. And they had purchased it, and it had gone from $200,000 and tripled in value over time, just a hot area they were in. So immediately they had a lot of anxiety, right? If you recall, they were the woman was really upset and thinking, how am I going to pay the bill?
Yeah, and I think a lot of times like our clients come in or people that prospects that become clients come in and they have like that one issue. They're like, we need to solve this issue, and I think the good part about our process is we're like looking at the full picture. So I think that's like a good thing to note is like we do a pretty holistic questionnaire process, and they might think that we're going to do something completely different, but they might already have the pieces of the puzzle together, right?
Correct. Yeah. So this was a great example of that, where the first thing we do in that situation, right, is that we started talking to the client was, okay, like we have to approach this with calmness, right? If at the end of the day a tax bill is owed, it's not the end of the world. We can work on a strategy there from cash flow to pay for it. But the nice thing was someone had put a bug in this prospect's ear that, hey, you should talk to a CPA before the end of the year, not after the end of the year. So that being said, we had some time here. And the other thing that I'll note is the property had already been sold, right? So the first thing we told her was, look, there might be things we can do. We don't know really anything about your situation, but I wish you had come to us like 6 months ago before you sold the property, because kind of your options are limited now, right? So that was kind of the initial process. It was really just easing the anxiety, saying, hey, look, if the worst case scenario comes true, we'll still try to work with you as a rental property investor to make the situation better and hopefully find other techniques to save cash to pay for those taxes.
Yeah.
Not the greatest thing, right? But that was always on the table.
Yeah, totally. So just to set the stage, as Greg kind of alluded to, so prospect comes in, they have sold a rental property, right? Happens a lot. $80,000 gain, or that's what we kind of forecasted. And then
$80,000 tax bill from the gain.
Yeah, $80,000 tax bill. So way worse. So what do we do next? Like how did we take a look at that?
Well, once the client onboarded with us, we said, hey, we do this stuff all the time. There's probably 12 to 15 capital gain strategies out there. You've halved your options because of the timing of this, but let's get on board. Let's do what we can do. And let's work our magic. And I think what's different about our process here, John, just from working at other firms in the past and know how they do things, is it's not always spilt milk. We said, we're going to do our best. We're going to put hours and hours into this to figure it out. And we're going to do our scientific investigation, we call it, or our R&D of the tax code, to figure out what we can do here.
Yeah, right.
So as the client onboarded, we do what's called the discovery process. So we really just learned a lot about their life, all their assets, their moving pieces. And we had the aha moment, right? Like that's probably the greatest feeling in tax planning, when you see that thing, that piece of the puzzle, that you're like, wow, we're in the money.
Oh, totally. Yeah. I mean, that's why we do this, right? Like we know we can bring tangible benefit, like immediate return on investment for our clients. When we see those things out there, there's no better feeling. And in this instance, right, so this client had moved her residence, so she had a primary residence that she was using as a rental.
Right. So what we figured out, when you're looking at a tax return, there's a lot of names and numbers, a lot of property addresses you're trying to figure out. So we had to kind of map this together. So we put a map together of the client's now client's assets and all their properties. And we were initially a little confused, actually saying, "Hey, I don't understand why you're talking about rental income on this specific address because that address is on your 2023 and 2022 tax returns as your residence. So like, are we mistaken?" Well, what we found out was, she said, "No, you're not mistaken. When I moved out of there about a year ago, I want to keep that long term, so I actually started renting it out. I put it on the market and I rented it out." So in her mind, right, it was still kind of her primary residence in her head because she had been there for a long time. But tax wise, she'd actually converted it to a rental property, and she had sold a second rental property in the same town, right? So that was actually part of the puzzle was, okay, there's actually two separate properties in the same town. One was a rental that was now sold. One was her primary residence, which now she told us, "Oh, I've actually been renting that out for the last 9 months."
Yeah. So that's when we go ding, 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 like bells in the head, right? We have a rental property that she's using and we have the one that she sold, right? So when we have this other rental property, that kind of, in our minds, the bell goes off for like, hey, maybe this is a lazy 1031 exchange opportunity.
Exactly. So when we talk about our 12 and 15 strategies, this one, I'm not sure who coined the term, but we call it here a lazy 1031 exchange. So for those that don't know, a true 1031 exchange, right? When I mentioned she could have come to us earlier, if she'd come to us earlier, right, she had the potential to do a 1031 exchange on this property before she sold it. But once you sell the property, you can't do it because you can never take the proceeds. You can't take title to the cash on a true 1031. So in this case, she was like, "Oh, I know about a 1031. I can't do it." And we said, "No, no, this is called a lazy 1031." So what it really is, John, right, is we were able to say, "Okay, great. Now that we have the former primary that's now a rental property, we are going to use a cost segregation study on that rental property. That's going to produce a nice loss," right? She had some rental income, but now with a mortgage interest and the high depreciation from the short-term assets we're going to find, taxes, all that kind of stuff, she's going to have a loss on that rental property. Hold on, the next thing someone's going to say, "Well, it doesn't matter. It's passive." Correct, right? This person was not in the business of real estate. These are passive properties you're talking about. She's not a real estate professional. These are not short-term rentals. So again, a lot of times people say, "Well, okay, what's the point?" Well, the point is a lot of people get confused. The gain from the property she sold is considered a passive activity gain. Passive activity gains can only be offset by what? Passive activity losses or active losses. We can create a passive loss for her on her new rental property by doing the cost segregation study. So what we clicked in our head was, okay, she still has this one rental property. We're going to create a loss on that rental property, which is a passive loss. That passive loss is going to go and almost offset all of the gain on the property she'd already sold. Voila. All of a sudden, that tax bill now is looking a lot better.
Yeah. All right. So let's break that down a little bit further. So first and foremost, a regular 1031, and the reason why this is lazy is because a regular 1031, like you said, it's strict, right? There's a ton of rules, right? So you got to do it before, you have to have everything set up before you sell the property. And then there's time frames. We have to trace the gain. So there is a lot that goes into it. This is something that is just way more flexible. You need to have the pieces in place, but and this particular client did. So she obviously came to us. She had already sold the property, and then we identified the second property, and then the next thing we did was like, okay, let's run a cost segregation study.
So cost segregation study, we'll do a whole nother episode on that, but run through the process there. And generally speaking, like as tax planners, we back in the envelope math, we knew them how the math was going to work on the cost seg study. Within reason, we had an idea about
Why do we have to do the cost seg study?
You have to do the great question, John. So that you have to do the cost seg study because I guess the easiest way I explain to people is this, right? When you go and buy a property, whether it's a personal residence or a rental property, it's just say it's $1 million to make the math easy. We all wish it was $1 million, but let's say it's $1 million. You get title of that property. It just says $1 million on the P&S, right? It doesn't say $850,000 of building, $150,000 of land, and then of the building, cabinets, flooring, HVAC, windows, doors. Like it doesn't break those things down for you, right? The tax code allows you to do a qualified engineering study to break down the component parts of a property. So what I tell people is, hey, look around the room you're in, right? We have lights, we have walls, we have carpet here. All that has different lives in the tax code. If you go through the work to do a cost seg study, you can assign lives to all those things. Okay, Greg, why does that matter? It matters because on items that are in the 3 to 15 year class, we can elect what's called bonus depreciation, meaning we can write those off in the first year. So her first option, option one, is do nothing. You get a nice 39-year depreciation schedule on that new rental property. Not great. Or about a third of that property value that she had, we're able to accelerate using bonus depreciation, creating a nice large loss.
Gotcha. So you need the cost segregation study to basically understand what you can bonus on that property.
Correct. Unless you're self-constructing a property and you have those records, you're going to do a cost seg study to do this. And these are IRS approved methods that you can use. And there's different navigations of how do you report this, but that's the general theory.
Gotcha. Okay, so we do the cost seg. We understand, hey, this is client, this is what we can accelerate, and that will offset the gain that you have on the rental that you sold. And then the last hurdle that you said was, well, generally it doesn't work that cleanly, right? Because it's, we have a passive active situation.
Mm-hmm.
But in this situation, because she sold the property, we were able to net those.
Correct.
Losses.
So that's a great point, John. So if the client did not have that gain, right? We just did the cost seg study on the new rental property. She would probably be disappointed because it was a passive loss we created. That passive loss would either offset other passive income she had, which was actually zero, or just sit on her tax return as an accrued unused loss moving forward. What's the point of that, right? So this was a unique scenario where we purposely created a passive loss. The character of income was passive because the gain on her property that she sold was passive. A lot of CPAs miss this, right? That they'll say, "Oh no, it's passive," right? A gain has a character as well. It's a passive gain. So for the tax nerds out there, if you look at the mechanisms of Form 8582 and how that flows to like a Form 4797 for tax reporting, you'll see how these losses can offset these gains if done properly. So just a quick aside there for the nerds out there.
Yeah, we need to give the nerds something. Yeah, so it's definitely something too where like we get the situation like this is a home run because there's no additional investment for the client, right?
Correct.
Like generally like you have these types of situations like you might have to allocate some investment towards something to be able to generate some losses. Here it's already in her portfolio. She had no clue.
She just didn't know, and she actually did have a CPA as well. And unfortunately, the advice she had gotten, and I'm glad she got a second opinion, was you just got to pay the tax. That's actually the advice she got was
Right.
just pay the tax. And fortunately, she did some self research, came across us, and that's how this all happened. Now, that situation ended up pretty good, right? So we didn't eliminate the full tax bill, to be clear, right? So John said $80,000 gain. That whole strategy we pulled off, the lazy 1031, saved about $50,000. It's still over 30, but that is a lot better situation than thinking you're going to owe 80. And in fact, this person had also started their own business. So they had that $50,000 of capital now, which really reduced stress and anxiety, which is probably the best feeling we can give.
Yeah, totally. Yeah. And listen, I think it also speaks to the fact that like we're looking at someone's like current portfolio when they come in, and it's like, what pieces do you have? Like I want to bring it back to like, what do you already have that we can leverage to offset your tax before kind of looking outside, right? And like I said, when those things come together, there's no better feeling.
Absolutely. So let's just talk about in general, like the capital gains world. What's our angle on this? How do we approach capital gains? And I will say, first off, capital gain situations are probably the easiest for us to handle of all things, right? So you have people with high business income, high W-2 income. They might have this high passive income, portfolio income, like interest dividends, capital gains. But these capital gains, right, are the easiest of everything that we do from a tax strategy perspective. So
Right.
we're not going to get into every strategy today, but John, how do we think about capital gains when it comes to tax planning, or someone out there that's like, hey, I know this capital gain's coming. Like, what do I need to be doing?
Yeah, well, I think at first we always want to understand like, well, what is the gain, right? Like obviously capital gains can come in many different forms, right? Is it like this client, she sold a rental property? Are they more portfolio in nature, like you said? Are they selling a business, right? Like obviously the magnitude and what is it, the actual asset that is being sold is a big part of it. I think sticking with like the real estate world and kind of, I think it's a good segue based on what we just talked about is, the concept of, short-term rentals, right? When you kind of have those issues where you want to net income and losses together. Short-term rental is always a good way to do it, right? It's been coined the short-term rental loophole, and you're basically doing the same thing that we just discussed, but you're purchasing a short-term rental, and you can net losses because of the material participation in the short-term rental. So you're still doing the cost segregation on that short-term rental. You're materially participating in it, You're renting it out an average 7 days or less, and you're effectively having the same result as what we just talked about with our client here.
Right. So a different way to look at it. If this person had enough time in the year, they could have also done that. Or anyone could really do that, right? To offset a capital gain, or even in John's case, that strategy, the short-term rental strategy, can offset other types of income as well. Other things we'd probably look at, right, especially in a real estate situation. So we mentioned a traditional 1031 exchange that has to be done before, right? So there's a really strict rules there. They're not always the greatest thing in the world, but you can do a traditional 1031 exchange ahead of time. If you don't want to go into maybe active real estate on the back end, you can do a 1031 into a DST, right? Complicated, but you can do that. Other things we'd probably look at in these situations, you'd probably look at the strategy of an opportunity zone, right? So those
Right.
those are popular, but I think our experience with opportunity zones, what that is really is reinvesting the gain, not the proceeds, the gain into a qualified fund, which is in the tax code, and then you can have some basis step up starting next year, and you can defer your gain. But I think our experience, John, has been that a lot of people talk about doing them, but they don't actually love tying their capital up.
Yeah, that's the thing. It's gonna be tied up, and also like there's a lot of opportunity zone funds that are being thrown around, right? I think there's a lot of diligence that has to go into placing your money in those private funds, and I think that sometimes there's issues with that as well.
Absolutely. There's the opportunity zone strategy. There's also some charitable things out there, right? There again, these are pre-planning techniques that you could do, especially with a real estate gain. So there's I mentioned 12 to 15 strategies, a lot of things you can do, and even if you have ordinary income strategies, you can pull off here as well because ordinary income strategies are powerful. They can offset both capital gains, like John's strategy with short-term rental is powerful because it can offset capital and ordinary income done properly. So we'd kind of look through the full playbook and say, okay, like what's even on the table here? Because some of these things that we're talking about take capital, right? It takes money to make money. And if the person doesn't have adequate capital, then like that might cut the list down in half. But that being said, if there's 15 things out there we can do capital gains, it's likely something's going to work
Yeah.
if the person's motivated to do so. But we always say don't let the tax tail wag the dog. So it has to be a sound investment or sound decision. And if all those pieces line up like it did in our case study today, it can be a home run.
Yeah. Yeah, and I think it's like first we're going to look at it. Hey, what can we do in the current portfolio? Then if there's opportunities where we have to allocate capital, then we'll move to that. I do think it's good to note just like the how we tailor it depending on what our clients' intentions are. If they are charitably inclined, there are a lot of opportunities there, right? And those can
Sure.
range from like simple to complex, and you don't need to be in every single bucket, right? You can do things that are as simple as just setting up a donor advised fund,
Yeah.
which is really just, you're ultimately just donating money into a fund that you can manage and then deploy, really whenever your preference is. Then there's trust structures that are charitably inclined, and then upwards to like operating your own private foundation, right? So like you can
Yeah.
do anything.
Yeah, so a lot of items there. But again, there's complexity levels to all this stuff, and you gotta make sure that you have an expert on your side at time. But as we head down the finish line here, I think like one thing we want to always tell the audience is how do you do this? How do you work with your tax professional, your CPA, your lawyer, whoever it may be, to do this stuff? And I think the first thing is you gotta speak up and ask. If you are told, hey, you're gonna pay X dollars in tax on this gain, in our example today on this property sale, just time out, right? Press pause and just say, is there anything we can do? And if you're met with an answer of there's nothing you can do, personally, I would seek a second opinion because that's generally not the truth. There's generally something you can do, unless you're in this next tax year and a lot of things have already happened.
Right.
Generally speaking, if you do this early enough, you can do it. So if you see something coming out of the pipeline at you, it could be a capital gain from the market. It could be capital gain from options you have in a company. It could be a property sale. It could be your business, whatever it may be. Start having the conversation now, right? It's not going to hurt. You're going to feel a lot less anxiety and a lot less pressure if you know the menu of options that you
Yeah.
have.
Yeah, and I think that's a good point. Like you have to ask the question, but also I do think it's a red flag, right? If you're coming in the door for a new like tax professional solution and they're not asking you the questions, like they're not
Yeah,
getting
right, right, right.
everything, right? Like the what we talked about today, right? When we wiped out a good portion of that $80,000 tax bill, we have a process where we're looking under every rock. We want to understand the whole picture because that's how you can make decisions. And if you're kind of coming into a situation and they're not even getting that information from you, then you're kind of already losing.
The reason for that, right? Again, we probably say this a lot, is that most CPA firms, most enrolled agent firms, they are in the cycle of tax compliance. They have thousands of clients and they do this. They don't have time to do that deep dive discovery into your situation. The easy thing for them to say is just pay the tax, right? So don't always accept that answer because there might be something you could do.
Yeah.
So, go ahead, John.
No, I was just gonna say. I mean, that's the biggest thing that underpins everything. Is like if they don't have the full information, they're not asking for it, then you're not gonna get results. There's no way.
Absolutely. And that just goes down to the model of it. And like, I think our passion here is finding those tax savings, putting them on our list and adding up and not overpaying the government when we don't have to. So if you're interested in gains planning or overall tax planning in general, our team's always willing to talk. Check out the link in the description here, fill out an inquiry form. Otherwise, we'll see you next week. And John, great week.
Yeah, great week. I'm looking forward to hearing from you.
Take care for now.